Historically, whenever the government, the Federal Reserve, believes that we are tipping into a recession in the last decade, decade and a half, the Federal Reserve has notably always come to the rescue by doing what? Lowering interest rates. Where did interest rates go recently? Well, because we had massive inflation. The first time we had massive inflation since the 1980s, the Federal Reserve had to raise interest rates. You know what's happened there. Mortgage interest rates go up, credit card interest rates go up, auto loan interest go up. Everything goes up and makes the consumer and business borrowing power decline. Makes it more difficult. The credit markets tie things up and business and investors can't expand. Asset prices come down, disinflation, right? That was needed to reduce the inflation, but now we have a situation where I believe Jay Powell and the other Fed chairmen realize that they may be walking into a trap. Maybe they already have, by causing a greater downturn in the economy than they want to. Look, they're trying to balance like a seesaw. And we've got an election coming up in less than 2 months, and I think there's a lot of a political side to this as well. So even though they tout that they made this interest rate cut because inflation has basically been slaughtered and they feel like they've hit that home run, I don't think that's true. They're also afraid that the economy is tipping too largely into a recession, but they won't say it. So where are we in terms of what we do with our own investments? We love to be in growth mode. We love it when we can invest in equities. That's businesses. That's real estate. That's the financial market. Tech stocks, which have gone to the moon in an environment where we've had typically low interest rates, but also the fuel of the Federal Reserve and the government spending trillions of dollars of money that we don't have. That's like a family, your family, living on credit cards and HELOC loans to bolster your lifestyle and thinking, hey, it's all good. This feels good until the day of reckoning comes. And for the most part, the U.S., America, has been a superpower for well over a century, many, many decades. We have been a superpower because of our ability to be entrepreneurs, and in capitalistic markets, we've been great producers. But we've overextended ourselves. The government has. Our irresponsible politicians have overextended us and continue to do so on steroids today, as if it doesn't matter. At some point, it will matter. And I think that's what the Federal Reserve is afraid of, that they've gone too far. So where do we go with our investments? Again, we love the growth. We love to be in a market where things are going up, 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 because that's what creates more wealth for us. But when we're in a market cycle that's turning from a half cycle that was up growth now to a downturn, a recession, a correction, which is the other half of the market cycle, we've got to be more careful. I believe this is not a time to be in equities in general. Again, you can decide for yourself where you stand, but you've got to be very careful because we're not going to have the same upswing in the marketplace until we go through this correction. I like to be in private credit. What's that mean? Being the bank, I can be in a position where I can lend my money based and supported by strong collateral to borrowers who I get to vet and get a contractual return on my money, certainly into the double digits. It's like buying treasury bonds, which in the US, backed by the government, treasury bonds, bills, short-term, medium-term, are considered to be risk-off because it's backed by the government. But those are returning today 5% and going down. That's okay for the short term. But with inflation, I believe, still ripping much higher than that, my purchasing power is going down. So I've got to do better in some regard than 4 or 5%. If I can double that, again, by keeping my risk reduced, by being the bank, by lending money in the private credit sector, my opportunity to stay ahead of inflation but not have the risk of being in equities is greater. And then when it's time to turn back into equities, I can move that money there. This is an opportunity, I think, for investors to realize that the volatility of the marketplace, which is typically not what we want, but it's a time when we can fill the voids and the gaps of putting our money into places that others can't.